Okay, guess what? The Secure Act, it just blew up the rules around stretch IRAs, otherwise known as inherited IRAs. Absolutely insane. So the Secure Act is this massive piece of legislation, and it has provisions in it that go everywhere from, paying off your student loans using 529 funds to what I'm talking about today, which is the most impactful in my opinion. It's the provision that's going to pay for all the other things because it brings in $15.7 billion in revenue to the Treasury over the next 10 years alone. Hi there, my name is Ashley Micciche. I'm the CEO of True North Retirement Advisors, where we specialize in retirement and exit planning for business owners. Okay, so let's take a step back here and talk about the old rule with stretch or inherited IRAs and the new rule under the Secure Act. Prior to 2020, if you inherited an IRA from your parents, you, in most cases, would have been able to take those distributions. So you're required to take money out every year, but in a lot of cases, you could do that over your remaining life. So if you inherited this money when you were, say, 55 and you live to be 85, that's 30 years that you can spread out the distributions and, more importantly, spread out the taxes, because every dollar that you pull out of an IRA account is subject to tax. So what happens with the stretch IRA is, instead of taking it out over 30 years, let's say, you now have a cap of 10 years if you are a beneficiary to take that money out. Now, there's some exceptions to this rule, but in general, most people, you're the account owner and you're married. When you die, it goes to your spouse, and then when your spouse dies, it goes to your kids. That's how most people have their IRAs set up. And if that's the case for you, then this is almost certainly going to apply in your situation. Here's the problem though. Let's say that when you die, you have $1 million in your IRA that gets split two ways between both of your kids. So they each have $500,000. Each of those beneficiaries their income is going to jump by $50,000 each and every year for the next 10 years if they do that full stretch IRA. And the other issue with this is that when most people inherit money, they inherit in their 50s and their 60s. These are often the peak earning years. So when your income is already as high as it's gonna be in your working career for the most part, you're adding on sizable retirement required distributions from mom or dad's IRA on top of that. And it can wreak havoc because it throws you into all new tax brackets. And that money that your parents worked so hard, or if you're watching this and you're the account owner, the money that you worked so hard for could potentially be subject to, like, half of it could go to taxes, because if your kids are in a higher tax bracket, it just bumps them up even more. So what does this have to do with the Roth? Well, the Roth just got a lot more attractive because when you put money into a Roth, you're taxed on it that year. So you don't get the tax benefit on the contributions, but then it grows tax-free from there. And then when you pull the money out, whether it's you or your beneficiaries, that money is not taxed. So there's this unique opportunity now where if you weren't already contributing to a Roth, you may want to look closely at that, because the more money you can get into the Roth and out of the traditional IRA, the better. And there's a couple of ways you can do that. One is through conversions. So you can take money that you already have an existing IRA or 401k account, and you can convert that, pay the taxes now, convert that to a Roth. Now, historically, taxes are pretty low right now, and so it's a good time to look at doing that anyway, even if the Secure Act hadn't recently passed. The other strategy that I think makes a lot more sense, because you're not paying taxes on those conversions, is looking seriously at Roth 401k or Roth IRA contributions. But I specifically want to emphasize the Roth 401k contributions, because if you have access to a 401k plan through your work, there's a decent chance that there's a Roth option attached to that. And if you are over 50, you can put a substantial amount of money into a Roth 401k every year. I believe it's, oh gosh, correct me if I'm wrong, but I think it's $25,000 for 2020. My brain is still on 2019 numbers. But if you are over 50, you should be able to contribute $25,000 to your Roth 401k in 2020. So, and if you're gonna work, like let's say you're 50 and you're gonna work for 15 more years, that's a substantial amount of money that can be contributed and grow and not be taxed later on, that is now inside of your Roth. So really big planning opportunity that now exists with the Roth. If you have a large IRA balance and those 10-year distributions are likely going to create a pretty big tax bite for your kids and just hand over, half of your IRA balance to Uncle Sam through that, there are some additional planning strategies beyond the Roth that you may want to consider. There are ways that you can minimize taxes. There are ways you can set up trust. There are ways, maybe you shuffle around the beneficiaries. Maybe you switch how you take the distributions from your account. So traditionally, the conventional financial planning advice around withdrawals and retirement is that you take out of taxable accounts first, and then once those are depleted and you have to start taking those required minimum distributions from your IRAs, then you take it out of those accounts. And then if those get depleted, then you take out of your tax-free accounts like your municipal bonds or your Roth IRAs. Well, it might make sense now, because of these new rules around the IRA stretch, maybe it makes more sense to preserve more of the taxable account, which is likely to be taxed at a lower rate when it gets inherited by your beneficiaries, and then deplete more of the IRA account now. Again, this isn't like a blanket recommendation because it depends on the account types that you have, the account sizes, your income. There's so many factors, including like what state you live in too. So you really do need to talk to your tax advisor and your estate planning opportunity to see if the new change of the law with the stretch or the inherited IRA is going to have an impact on you, and if there are planning strategies that you can undertake in order to make sure that you are being as efficient as possible with those hard-earned dollars and not handing half of them over to Uncle Sam when your heirs start taking those distributions. So I hope that was helpful. If you like this video, if you found it helpful, consider subscribing, where we put out new videos multiple times a month. Almost every week we're putting out new videos, all centered around retirement planning and exit planning for business owners. So thank you so much for watching. My name is Ashley Micciche, and I will see you next time.